Hello, class. So I want to go over the prepaid expenses and unearned revenue. Okay, so there's a couple of principles in accounting that you have to remember. All right, and let me just type them over here real quick. And you want to probably write these down and remember these. So revenue is increased when earned, not when paid. Okay, and expenses are increased when incurred, not when paid. All right, so revenues are increased when earned, not when paid. Expenses are increased when incurred, not when paid. So let's just go over a brief example of that. So let's say that I pay, let's say I pay an electric bill. Okay, let's say I have a $75 electric bill and I pay with cash. So there, what I'm going to do is I'm going to credit my cash. Okay, $75, and I debit the expense $75. Okay. So just like what we went over with the T accounts in the previous video. So now what if I pay an expense before it's due? What if I pay an expense before it's due? So for example, let's say that we rent out an office building for $1,000 per month starting in January of 2021. And so the rent, let's say that let's say it's actually January 1st of 2021. Okay, and then the rent is due for the first month's rent due on January 15th and due on the 15th of each month going forward. Okay. All right. So also on January 1st, 2021, we pay 12 months in advance. All right, so let's say we don't want to deal with the bill every single month. Therefore, we're just going to go ahead and pay the 12 months and just get it over with, so we don't have to pay attention to the expense anymore. Well, have we incurred the expense yet? No, we have not incurred the expense because the rent is not due yet. Okay, we don't pay, we only recognize the expense when the rent is actually due. Therefore, on January 1st, since we paid $12,000, which is 12 months in advance at $1,000 per month, we're going to decrease our cash by 12 grand, and then we will increase prepaid expenses by $12,000. So that's the entry on January 1st. And then when January 15th comes around and our first month of rent is due, we're going to credit the expense, the prepaid expense account, $1,000, and then take that over to the expense account. So then on the 15th of every single month, we just make the same entry over and over again for the next 12 months. So whenever you pay an expense ahead of time and it's not due yet, you're prepaying the expense, you're going to credit the cash and debit the prepaid expense. And then as the expense comes due, then you credit it for the amount that's due, the prepaid expense you credit, and then you debit the actual expense account. Okay, so that's how you treat prepaid expenses, and so in expense accounts. Now, let's say that we have kind of the same thing go on with our revenue. Okay, so again, revenue is recognized when it's earned. So let's say that let's say we mow somebody's yard and we charge them $3,000 and they pay us $1,000. Well, what we're going to do is we're going to increase our cash by $1,000 and then increase our receivables by the $2,000 and then increase our revenue through $3,000 because we earned $3,000. And so what we're doing is we're recording that we got paid the $1,000 and then they're going to owe us at a later date $2,000. So we have to record the revenue when it's earned. Now let's say that we have a client pays us, let's say $5,000 to mow their yard each month for the next 5 months. Okay, so it's going to be $1,000 a month, right? And we have not mowed any yard yet, so we have not earned any revenue, but we've received cash, so we have to record that. So what we're going to do is we're going to debit our cash for $5,000, and then we will increase under liabilities. So we increase under liabilities $5,000. And so this is now the reason it's a liability is because do we owe this client anything? Yes, we do. We owe them, we don't owe them money, but we do owe them some mowed yards. Therefore, unearned revenue is under liabilities. Now, every time we mow their yard, so let's say a month goes by, we mow their yard, the amount that needs to be mowed by, then we've earned now $1,000 because that's $1,000 a month. So we're going to debit unearned revenue by $1,000 and then credit the just plain revenue account under equity $1,000. And then another month goes by, so we'll debit unearned revenue $1,000 and credit revenue $1,000. All right, if you still have questions for this, please reach out and maybe some further explanation can help you or go over a different example. So thank you for watching.